All right, let's jump right into it. Welcome to this explainer. Today, we're literally following the money straight into one of the most high stakes, opaque, and wildly influential corners of the global financial world. We are decoding private equity. You see, this is a massive, multi-trillion-dollar universe of capital that quietly operates entirely behind the scenes. They're buying up the brands you know, fundamentally changing how they run and generating absolutely immense wealth in the process. Look, if you really want to understand how modern capitalism actually functions behind closed doors, you have to understand private equity. So get focused because we are going to break down exactly how this machine works. Here is our roadmap for the explainer today. We'll start with number 1. What is private equity? Number 2, the 4 flavors of PE. Number 3, the players and the structure. Number 4, the math behind the money. And finally, number 5, value creation in action. Okay, let's dive into this with Section 1, what is private equity? The big picture. Let's establish our foundation. If we start peeling the onion here, private equity is exactly what it sounds like, right? It's capital invested into private companies. But importantly, it also includes buying out publicly traded companies, yanking them off the stock market, and taking them private. And this is the entire lifeblood of the industry. You improve their value over time and you sell them for a massive profit. They buy, they fix or grow, and they sell. It is just a relentless pursuit of compounding value. Now, to really grasp this, we need to draw a sharp contrast between private equity and what most of us are familiar with, which is the public markets. When you or I buy a share of stock on the public exchange, we're passive investors. We buy it, we hold it, maybe we sell it a few months later, but we have absolutely zero say in how the business is run. Well, private equity is the exact opposite. It's totally defined by active ownership. These firms seek long-term returns by literally getting their hands dirty. They force operational improvements and they provide very aggressive strategic guidance. Basically, they don't just bet on a horse, they buy the horse, they hire a new trainer, they upgrade its diet, and then they sell it when it starts winning all the races. Moving right along to Section 2, the 4 flavors of P, the investment targets. Let's see where all this capital actually goes. There are 4 distinct flavors of private equity, and honestly, the easiest way to understand them is to think about real estate. The first flavor is venture capital. This is like buying a plot of completely empty land. It's early stage, it's very high risk, but there's a huge potential upside if a city suddenly grows around it. Think of tech startups in their early days, like Uber or Airbnb. The second flavor is growth equity. This is like taking a perfectly good house and adding a massive extension to it. You're providing capital to mature, expanding companies that just aren't quite ready for an IPO yet. Spotify, right before it went public, is a perfect example here. Then we have buyouts. This is the classic mansion flip. You acquire majority control of a mature, profitable business, you streamline it, and you boost the profits. Blackstone's massive acquisition of Hilton Hotels is the textbook example for this one. And finally, distressed investments. This is essentially buying a foreclosure. Firms like Oaktree Capital will buy struggling, bankrupt companies at a steep discount, purely to turn them around. So, 4 totally different strategies, but they all fall under that massive umbrella of private equity. Okay, Section 3, the players and the structure, the ecosystem. We need to know who's actually pulling the strings here, and whose money is this anyway? Every single private equity fund is split into 2 distinct groups. On the one side, you have the general partners, or GPs. These are the Wall Street titans. They manage the fund, they do all the heavy research, and they make the ruthless investment decisions. But here's the catch. The GPs don't provide the bulk of the money. That falls to the limited partners, or LPs, over on the right. LPs provide the massive pools of capital required to actually buy billion-dollar companies. And who are these LPs? Well, they're university endowments, family offices for the ultra-wealthy, and incredibly institutional pension funds. Think about that for a second. There is a very real chance that if you have a state or corporate pension fund, your retirement savings are actually bankrolling these massive corporate buyouts. And because this process involves transforming entire companies, the GPs and LPs are locked into an extreme long game. A typical fund's life cycle spans 7 to 10 years. Year 1 is purely fundraising. The GPs are flying all over the world convincing LPs to hand over their cash. Years 2 through 4 are the hunting phase, where they actively buy up those target companies we talked about. Years 5 through 7 are the managing phase. This is executing that active ownership, fixing operations, slashing inefficiencies, getting things running lean. And finally, years 8 through 10 are the exit phase. That's where they sell the upgraded companies for a massive profit and return the initial capital plus the gains straight back to the LPs. Which brings us to Section 4, the math behind the money, the economics. Let's follow the money and see exactly how these fund managers get so incredibly rich. Now, what's really interesting about this slide is the golden rule of private equity compensation. It's the famous 2 and 20 model. First, let's look at the 20. When a fund makes a profit from selling a company, the pie is split. The GPs, again, the ones managing the fund, they take a massive 20% slice of those profits. In the industry, this is called carried interest, or just carry. The remaining 80% goes back to the LPs who actually provided the initial capital. But make no mistake, that 20% slice of the profit pie is literally what drives the unbelievable wealth generated on Wall Street. But hey, the carry is only half the story. The other part of that model is the 2. The GPs also charge a 2% annual management fee on the total size of the fund, totally regardless of performance. So let's do the math. If you're managing a $10 billion fund, you are collecting $200 million a year in fees just to keep the lights on before you even sell a single company. Pretty sweet gig, right? Now, the LPs aren't foolish. They want to protect their massive investments against mediocre performance. So, along with that 2% management fee, the structure includes strict safeguards like hurdle rates and preferred returns. Essentially, a hurdle rate dictates that the GPs don't get to touch their 20% profit slice until the fund achieves a specific minimum return for the LPs first. It ensures that the general partners only get incredibly wealthy if they actually deliver superior, outsized results for the investors supplying the capital. All right, Section 5, Value Creation in Action, the playbook. Let's look at how these firms actually multiply the money once they take full control. So the crucial point is that private equity firms absolutely do not just sit back and rely on a rising stock market to make money. They forcefully inject value into a business. They generate returns through really aggressive operational improvements. We're talking cutting costs, upgrading legacy technology, and firing underperforming executives. They use financial engineering, optimizing the company's debt and capital structure to maximize cash flow. They provide high-level strategic guidance, and they demand incredibly active board involvement. Look, when private equity buys your company, they are putting their hands firmly on the steering wheel. To truly bring this theory to life, we have to look at a real-world example, specifically the legendary 1988 buyout of RJJ Nabisco by the private equity firm KKR. This wasn't just a transaction. It was an absolute watershed moment in financial history and a total masterclass in unlocking hidden company value that the public markets were just completely ignoring. And this brilliantly illustrates the two-step playbook KKR utilized. Once KKR took RJR Nabisco private, step 1 was executing operational efficiencies. The company was notoriously bloated, filled with extreme corporate excess. KKR came in and brutally optimized the massive, sprawling conglomerate. Then, step 2 was financial restructuring. By reorganizing the company's massive debt and spinning off underperforming divisions, they significantly increased the underlying value of the core business. Basically, they did the difficult, deeply unpopular dirty work that public CEOs often try to avoid, and in doing so, they created massive profits when they eventually exited. Well, we've unpacked the definitions, the timelines, the players, and the ruthless math of the 220 model. But I want to leave you with a thought that brings this entire massive global financial system right to your doorstep. We learned that the billions of dollars funding these private equity buyouts often come from the limited partners, which heavily feature everyday institutional pension funds. So the next time you walk into a grocery store or stay at a hotel chain or use a tech platform, ask yourself, knowing that your own retirement savings might actually be fueling this exact system, who really owns the brands you interact with every single day? It's a fascinating ecosystem, and I hope this explainer helped you see the invisible strings of private equity a little more clearly. Keep questioning, keep learning, and I'll see you in the next explainer.